Options trading is risky. Selling option premium is risky. I hear this all the time. I hear things in my comments such as picking up pennies in front of a steamroller, or options trading is like picking up pennies on a railroad track. The fact is that you don't have a choice. The only way that you can earn and achieve alpha in the stock market, which means the only way that you can earn an outsized return per the risk that you're taking over just simply holding an SPY index, is by selling option premium and turning yourself into an insurance company or acting like a casino. Day traders, they lose money. I showed you guys the study where 359,000 out of 360,000. Again, this is statistically significant. I'm not talking about the fake gurus on YouTube who make money from their subscribers and then are defrauding innocent people by telling them that they can make money by day trading. I'm talking about real life. And the fact is, you will lose money from day trading and you will lose money from trading Forex. The only way that you can earn consistent revenue, wherein consistent income, which is exceeding the expectation of simply holding an SPY index, is by selling option premium. So you don't have a choice. So anyone who tells you something like it's picking up pennies in front of a steamroller or picking up pennies on the railroad tracks, they are losers. They are losing traders. They don't understand how the stock market works, and they just want to hold you down because they hope that you lose money, and they hope that you continue to be like them because they are losing traders themselves. The other thing is, it's so important to have realistic expectations about expected probabilities and outcome. If you bought Amazon, which is $1 billion company, you don't assume that tomorrow it's going to go bankrupt. So why on earth, if you sell a put on Amazon that's trading for 10% below the current market price of Amazon? So again, you buy Amazon at, let's say, 1,700. Let's say you sold a put which obligates you to buy Amazon 10% below the current market price. So if its current market price is 1,700 and you sold a put with a strike price of 1,530, why on earth would you simply assume the next day that Amazon, $1 billion company, is going to go bankrupt? But David, oh my God, you have your max risk of $1,530 in that scenario. Okay, so you bought Amazon, or you agreed to buy Amazon at a 10% discount. You were paid probably around $500 per contract for the obligation or the ability to buy Amazon at 90% of its current market price. And now you're going to assume, just because you sold a put, that Amazon is going to go bankrupt tomorrow. Yet, if you bought the shares at the full price at 1,700, you're not even thinking that Amazon is going to go bankrupt. So again, why would you think when you sell a put that $1 billion company is just magically going to go bankrupt? Yes, that is so realistic of an expectation. Hundreds of thousands of people are going to lose their job. Look at Sears, for example. Sears is a tiny company that employs probably 1/200th of the amount of people that Amazon does. And Sears has been languishing in bankruptcy and been declining in relevance over the past 15 years. Yet, you sell a put in a market-leading tech stock, which is one of the most important companies in the world, and you automatically think that the next day Amazon's going to go bankrupt. And by selling a put in Amazon, you're really picking up pennies in front of a steamroller. That makes a lot of logical sense. And anyone who believes that selling option premium is dangerous when it's done correctly, you know automatically that you can just disregard what they're telling you, because you know that they are unsuccessful and losing traders, because there's no other way to make money in the stock market besides selling option premium. That's pretty much it. That's pretty much all I have to say. I mean, I think it's extremely ridiculous for people to have different expectations when you're talking about the same thing. If I buy Facebook right now, which is trading at around $165 a share, I will not have fear that tomorrow or next week Facebook is suddenly going to go bankrupt. But God forbid I buy Facebook at 10% below its current market price, which would put the price at around $148, which is a way better deal than me buying it at the current market price. And I'm not even talking about the premium that I receive. I mean, think about it. Facebook is at 165. I can sell a put with a strike price of 148, which obligates me to buy Facebook at a price that's even cheaper than its current market price. And I can probably pick up around $2 or $2.50 of premium. So as a result, my net cost for buying Facebook in the worst case scenario would be $145 versus the current market price, which is $165. And you're telling me that you're scared about selling an option when in the worst case scenario you own Facebook at $145, you would rather buy Facebook at its current market price of $165. It makes no sense, which is why I truly believe that so many viewers on Facebook, or rather so many viewers on YouTube, are self-destructive. You guys really don't want to make money. You just want to continue being victims and blaming someone else instead of taking action and learning a valuable skill so that you can improve your life. Because it's always easier to point the finger at someone else. This person is holding me down. This person screwed me. I'm a victim, as opposed to taking action, learning a skill, and improving your life. David Jaffe with beststockstrategy.com. Go to beststockstrategy.com and enter in your email to receive over $400 worth of free, valuable training materials. Please like, comment, share, and subscribe to this channel. Click the little bell so that you receive notifications about when new videos are posted. And if you have any questions, leave a comment below. I try to respond to everyone. Thank you for your attention.